Hello everyone and a very warm welcome to today's stock markets update for Wednesday, March the 26th, 2025. I apologize for the late webcast, but I had some computer issues. My screen went completely dark, but we're back and we're going to assess, did we have a dead cat bounce? Yay or nay? Was this all? And are we going to go to the low 5,000s on the S&P 500? Or is there more left in the tank? We think there's more left in the tank, but you can never be certain, so we always go by price levels. Remember, if we are in a dead cat bounce, then we just completed this wave A, then we just completed this wave B, which is the bounce, and now we're going to start wave C. But to know that for sure, we need to break below key price levels, and so far most indexes have not done that as all. So we have the first warning level, the second warning level, the third, and of course the final one, which is the recent low that the market made. And we've definitely not broken below those. So let's assess the charts and see where we are at. We're going to start off with the Nasdaq 100. This is the daily candlestick chart, and this is one of the paths we can look forward to if this is a bounce. It would be quite odd, though not impossible, for all of the B wave to have completed at a 38.2% retrace. It's very shallow because normally a retrace is somewhere between 50 to 76.4%. Now let me annotate the chart a little bit for clarity. So we have, of course, our warning levels for the bears. And yesterday we closed above the first warning level. That's about it. So anywhere between 38.2 and 176.4 is where you normally expect a retrace to happen. So this bounce can go all the way to 21,499. Okay, that is the 76.4% retrace, 21,499. So we can bounce that high. Now, typically in a bounce is where we see that the A wave goes to the 38.2% retrace. The B wave goes back to the 23.6% retrace. And then the C wave goes to the 61.8%. So it likely, if we just completed wave A, we're now in wave B, and wave C to follow, contingent on holding, of course, above key price levels. We definitely don't want to go below last week's low. That would be very worrisome for the bulls. So for now, this is the preferred path. And as you can see, we've just reached the minimum. 38.2% retrace is quite low for a bounce. Besides, the current price action is quite disproportionate to the decline we've seen. The decline lasted for almost a month, and the current advance is just 2 weeks. Not exactly symmetrical in price and time, but it would look better. So for now, this remains our preferred scenario, and we've had that on the map for quite a while. So far, so good. Contingent on holding above last week's low, which is pretty much Thursday's or Friday's low, I believe it is. Yes, Friday low. We should allow for this bounce to materialize, assuming this is a bounce, because we can also be in a leading diagonal first wave. They are overlapping 1, 2, 3, 4, 5. And the wave 3 is now underway. Wave 4 could have bottomed, and then wave 5 to ideally about 20,700. Possibly a little higher, about 20,900. Okay, it is not impossible for that to happen. So normally in a leading diagonal, the wave 3 targets the 123.6%. We haven't really reached it. Doesn't have to be. The wave 4 goes to about 61.8, maybe even lower, and then the wave 5 goes to 161.8, potentially 176.4, which is right here at the lower end of this ideal wave 1 target zone we've had on the map for a while. Then we'll see a wave 2 pullback in April, and then off to the races. So that would match really well. 1, 2, potentially still in wave 3, 4, and 5, and then the pullback. So we have the warning levels for the bulls on the chart. We definitely need to stay above 19,390. If it can do that, we can look forward to either this leading diagonal or a continuation of this bounce. So for the foreseeable future, we still cannot discern between either. But you can see both kind of point towards the same level, somewhere around 20,675, 21,050. 20,722, potentially 20,900. So that kind of matches really nice what the B wave versus the leading diagonal first wave. And then we'll have to see if we decline too deep, that then the C wave will announce itself, or it's just going to be a second wave. Those are the two options. So is it a dead cat bounce, yay or nay? We can't tell just yet. It is possible. We believe it's not, contingent on holding above 19,390 on the Nasdaq 100. That level is, in my humble opinion, really critical. If we get a daily close below it, all bets are off, and I think we can revisit the August 2024 lows in the low to mid 17,000s. All right, moving on to the S&P 500. Similar story. Here we use a simple closing price chart. And as you can see, also here, we just reached a 38.2% retrace. It's fine for a bounce. That would be a very shallow bounce, and that would mean this is a very bearish market, that all it could muster is a 38.2% retrace. It doesn't have to be 50, it doesn't have to be 61.8, it doesn't have to be 76.4. It can even do 23.6. All right, that we just don't know beforehand. But normally what you see is a subdividing bounce that targets the 38.2, then the 23.6, and then the 61.8. This is closing prices, so this can still close down to about 56.70, and then we move higher to around 5,900 on a closing basis, with of course some room for overlap and wiggling just a little bit below, just a little bit above. Similar to that chart, we can use regular candles, and as you can see here, we just went a little bit above the 38.2, a little bit shallow of the 50%. So this is the B wave, and then the C wave up to about 5,900, and then this larger C wave. So this is option A. All right. Option B is similar to the Nasdaq 100, where we are in this leading diagonal first wave. Also here, contingent on holding above last week's low, which is 55.95 for the S&P 500, we should then expect a overlapping rally to about 59.25, 59.75, similar to what we're looking for here. Okay, similar, 5,900, 59.87. All right, 59.25, 59.75. So we're getting really close to both. And then the market has to decide if it is indeed a leading diagonal. Due to the overlap of a leading diagonal, they're unfortunately hard to discern from a bounce. And then the market can decide that's all for the bounce. And we're going to go to the August low in the low 5,000s, about 5,100, or we're only going to get wave 2, 3, 4, and 5. Now, I do want to point out there is going to be a huge liquidity surge either later this month or next month, depending a bit on the offset. I will share this with my members in tomorrow's update. And that one suggests then if we are going to get a leading diagonal, that there will be just a wave 2 in April, and then 3, 4, and 5 will go into the summer. As you know, liquidity drives markets. Liquidity is two-pronged, meaning how much is there and how much does it want to be put to work. If there's a lot, you bet it also wants to pour into the risky assets. So this is option 2. Unfortunately, we're still unable to discern between the leading diagonal and the B wave bounce, and as long as we hold above last Thursday's low, we can allow for higher prices. The Dow Jones, also here, can be a C/3 wave or a first wave. To be determined. We don't know yet, and as you can see, the Dow Jones was unable to close below the first warning level, which is at 42,441. It stepped below it intraday, but that's it. So this one is back above the 10-day, the 20-day, and the 200-day simple moving average. Not too bad. However, we're still, of course, below the Ichimoku cloud, and we are, of course, still below the 50-day and Ichimoku cloud. We want to be above it, because above it, good things tend to happen. Semiconductors. We were questioning if we would see a wave 4-5 sequence like here, 4, 5, or if we would break above 47.76 and then go to 5700. Today's candle starts to suggest that this wave 5 is underway. Then we have a 1, a 2, a 3, a 4, and a 5. If that is the case, I'm going to look for a bounce back to about 5,000 and then a very steep decline. Then we have A1, B2, and then C3. Okay? Because then the market continues to move in 5 waves lower and 3 waves back up. So then we had 1, 2, 1, 2, 3, 4. Then we get this and then a very steep decline. Okay? So semiconductor bulls, you are really put on watch. If we see 5 waves lower and a break below the mid-March low, all right, the break below the mid-March low will be critical. And that one is at about 4,300. So we've reached the ideal wave 3 target zone. We've reached the ideal wave 4 target zone, and now we're closed below it. Now it remains to be seen if we're going to go to, I would say, the low 4,000s for wave 5 of red A1. And please remember, the semiconductors are not any of the other indexes, as clearly the price action since July last year is quite different than that, of course, for other indexes. You see this? The S&P 500 made an all-time high in February of this year. The semiconductors failed to make an all-time high and is now pretty much back to its August lows. The S&P 500 is well above its August lows. So please never say, oh, because the semiconductors are doing this, all the other indexes will do the same or that. Not true at all. The semiconductors is just a very small portion of a larger economy. It's just the semiconductor chip economy. Whereas the S&P 500 and the Dow Jones are, of course, a much larger economy. They capture many more sectors, many more industries than just the semiconductors. The same for the Dow Jones, entirely different worlds. So please do not correlate when there is no correlation. Similarly, for the small caps did fall a little bit short of a normal ideal wave 3 target zone, which is around here. We just got to the 123.6% extension, which means the wave 4 can go all the way to 214. And that's why we say above 216 really starts to increase the odds that this is not a wave 4. So far we're still topped in the ideal wave 4 target zone after just slightly bottoming in the ideal wave 3 target zone. It's still a bit smoke and mirrors. So if we go below the March low, then we'll see 5 waves lower. 1, 2, 3, 4, 5. And that means the larger top is in place. For the small caps, we're going to see a bounce, probably back to about, I would say, 216, 217 on the IWM, and then a very scary decline. That'd be not good, but it is very, very possible. So the small cap bulls are also placed on hold and on watch. Once again, this is not an index that I would confidently trade from the long side of things. This is a index. If you're long, you want to minimize any losses you'll have, especially if we will see 5 waves lower. Then any position you have should, in my humble opinion, be sold off into strength. Because after that, all hell in the small caps can break loose. If not, and we start breaking above 216 from current levels, with of course a first or actually second warning for the bears above 210, that really increases the odds that all we got was 3 waves lower and we'll see 253. Okay, so then we would see 3 waves lower and we're going to go to 253 for that much larger top. Then we move that one there. So also here, still a bit smoke and mirrors still for this index. Similarly for the semiconductors, definitely not a good candle today for the semiconductor bulls. If we go below the March lows, then we have 5 waves lower from the January high and all I then expect is a bounce before we're going to rattle much, much lower. And that doesn't mean the other indexes will rattle much, much lower, because once again, the semiconductors are pretty close to the August lows. And where are the S&P 500? They are way above the August lows. They made new all-time highs. Same for the Nasdaq 100. Completely different worlds. So this is where we currently are at. Did the dead cat bounce complete? It is possible. I have zero indication that is the case. We need to break below last Thursday's low to tell us that is the case. If not, we can still bounce higher to ideally about 21,040 to 21,500 on the Nasdaq 100. Same for the S&P 500, somewhere around 5,900 with an ideal target of 5,900 to about 5,975 for a larger bounce, which we carefully have to analyze to see if it's not going to be a leading diagonal. All right, those are the two options. Similarly for the Dow Jones, so far still only 3 waves up. We did reach the ideal C/3 target zone, but I must admit it's all a little bit short in time and price. So if we take here the advance like this, that's 100%, and we're going to add that to last Thursday's low right there. You can see we do need to go a little bit higher for the Dow Jones as well to even get a CSA relationship. Right, the CSA relationship is right there at 42,950, and we fell a bit short on that one. So also this first wave, we might have to increase it a little bit, should top out somewhere in that level. So again, we fell a little bit short of the ideal target zones. That could be bearish, but it will only be bearish if we break, of course, below the low here, which is 41,400 on the Dow Jones. I can't state it and repeat it often enough, but I think you get the idea. Once again, I apologize for the delay, but we're back on track. Take care, trade safe, and I'll catch you all tomorrow.